Welcome everyone to today's market structure update. I am David Easthope. I'm the head of Fintech research at Coalition Greenwich. I'm joined by my colleague Stephen Bruel. And as we like to say, these market structure updates are quick hitting in the worlds of market structure and financial technology. And today's topic is an exciting example of the intersection of those worlds. We'll be talking about collateral management. And before we get into the world of collateral management, Stephen, why don't you go ahead and introduce yourself as the newest team member, which is no longer my honor, is now your honor.
Hi, this is Stephen Bruel. I look after derivatives and foreign exchange here at Coalition Greenwich. So there'll be a lot of topics that we cover. LIBOR reform is going to be one, the changing nature of FX execution, but pertinent here, we also see a lot of changes happening in the collateral management space, in particular given some of the regulation, whether it's capital regulation or uncleared margin rules. So that'll be definitely a theme of some of the work we do over the coming months.
Excellent. Thanks, Stephen. It's exciting to see the world of collateral management and fintech come together. Today's topic is really about the intersection, the fintech enablement of that space. But before we jump into the solutions to some of the problems, it probably makes sense to go through some of the issues and challenges and problems as you see them, Stephen, in the broader collateral management world. So why don't you take us through that?
Sure. I think the collateral management process as an operational process has actually improved quite a bit over the past 8 to 10 years. It had moved from paper to Excel to fax, and now we do see a lot of solutions that have done a fantastic job of helping to automate various parts of the collateral life cycle. I'd actually say as well that I thought the industry has done a very nice job of collaborating and thinking about how the solutions can benefit everyone. And so again, we've seen a lot of investment from the industry into some of these solutions that have helped improve automation, improve throughput. And that's quite important because there are two key themes we really see in collateral at slightly high level. One, we see a large increase in the volume of collateral moves. And we are also going to see an increase in the value of collateral that needs to be moved. And so I think both of those factors lead to this idea that you need to focus a lot on your operational infrastructure in order to accommodate some of those changes. And you need to focus on how you use collateral to make sure that you're not either over collateralizing or under collateralizing. And frankly, to make sure that you have the right collateral in the right place at the right time. So some of the problems that we see today are going to, again, be driven by this increase in throughput that I mentioned. So there are certain firms that may still have some manual processes. The way I used to describe it was that we had various islands of automation, but maybe we didn't have all the bridges connecting those islands. So we've seen a lot of those bridges be built, but there are some areas where we still see, again, manual intervention in maybe the collateral selection process, for example. So what we're talking about here, as collateral velocity increases, how are you finding where your collateral is, locating it, doing the eligibility criteria, managing the haircuts, sending out settlement messages, ensuring that it settles, and then valuing the collateral going forward to understand what your collateral exposure is relative to your counterparty. Those steps that I mentioned, again, for some may be fully automated, but for others, there are a lot of different manual parts within that process. So I think that's operationally what folks are worried about. The other side of the coin, of course, is the value of collateral that needs to be moved and this idea of collateral optimization. Collateral optimization really means that you're identifying what trade will use the least amount of collateral. And then once you've executed a derivatives trade and you have to pledge collateral, what is the most optimal collateral to pledge based on the counterparty, the eligibility criteria, the haircuts, your internal rate of return, all those other factors that lead to an optimal collateral decision. So that's just a quick overview of some of the challenges that we see in the collateral industry today.
Thanks, Stephen. Yeah, it's interesting because you've given us both sides of the coin. On the one hand, there's just general efficiency gains to be made. Where that sort of intersects with the world of fintech is the rise of software as a service, various workflow solutions that can allow you to optimize your collateral. I'm thinking of firms, the Finastras of the world, the FISs, the Broadridges, the Smart Streams. All these vendors are really enabling the collateral efficiency and handling the operations side. Many of those providers are moving from software locally installed, of course, to SaaS. And there are newer breed of companies that are coming in with cloud native solutions. So both for native collateral and margining. So we think of firms like Cloud Margin, hence the cloud is in the title there. So I think that is certainly the trend in terms of the intersection of those issues and challenges within the fintech world. There is also the broader effect of the cloud as an infrastructure layer for those integrated and open architecture companies. So the rise of APIs, right? So the rise of interconnectedness in that middle and back office. And once again, you see some of the more cloud native companies come in and not just offer workflow support, but offer that sort of interconnectedness, that open architecture that so many of those firms that we speak to are looking for. They're not adopting it en masse, but they're very much looking for that ecosystem native API connectivity. And so I think that kind of efficiency side of the coin is being handled in a broad sense by those providers and those new architectures and new strategies.
And if I can just say something, and I think that's right. And I think if we think about this, I talked about the scale of collateral moves as a problem. But some firms might have hundreds, thousands of different collateral agreements. And if you have to try to manage non-standard data through multiple point-to-point pipes, you're really going to potentially fall down on your data management, data tracking, data enrichment exercises. And so this idea that you can have point-to-point solutions when you have thousands of different agreements really doesn't work. And so I think that's part of the reason we see what you described, which is more of an open architecture. Everybody can connect using similar APIs so that we're not, again, building all of these connections in a bespoke manner.
Yeah, great. And we talked about also not just technology, but emerging technology being a focus of our update, and also just looking at the collateral space and the application of emerging technologies. And you can't go anywhere in our universe without at least thinking about distributed ledger technology, or DLT, and broader blockchain. And I think what you've described in terms of the various problems in some ways does scream out for DLT, and other ways perhaps it's not as necessary. Some other things that are happening sort of on the margin in terms of automation and efficiency. But clearly there are some issues that you've identified that could be solved by DLT. That's the instant recording of collateral, that immediate settlement, real-time views into liquidity, even just restrictions to banking hours. As we know, the blockchain never sleeps. It's a 24/7 distributed ledger. And so, how are you thinking about that? I mean, I think that we can optimize perhaps through DLT. And are there some other areas that you think DLT could help on that sort of collateral optimization piece as well?
Yeah, I mean, the way I think about it, the idea is that the industry, as I said, has made a lot of progress, right? And so we've been able to wring out a lot of the inefficiencies without the DLT. And now we're to some extent, we're at some of the long tail of some of the issues, or some of the harder ones to resolve. The low hanging fruit resolved, medium hanging fruit resolved. Now we're at the higher hanging fruit. So I think the question becomes, if the industry continues on its path without DLT, when will these problems be solved, and will they be solved effectively? And then there's maybe a parallel path of what can DLT do to maybe accelerate that timeline. And so I think that there are going to be certain pockets where you might have some DLT solutions. You talked about sort of immediacy of recording of a transaction, and I think there are certain specific circumstances where that might work. Of course, there are other circumstances, where there might be delays outside of the scope of something that DLT might be able to address that might prevent that from happening. So I think the good news for the collateral industry is that we're looking at it, and there are a lot of potential use cases but we're not only looking at DLT as the solution. So I think regardless of which direction the industry goes, I think there'll be pockets of DLT, there'll be pockets of continued API, continued, fixed messaging, all of the other types of messages we have out there. I think we're going to see a combination of both, but I wouldn't be surprised to see some DLT hitting some very particular parts of the life cycle that could use some improvement.
Right, exactly. So let's look at that. Let's look at some of the issues that are solved by DLT. I think going of optimizing the matching that you mentioned. So while we should of course acknowledge that there are going to be, as anything, legal regulatory hurdles to anything related to DLT, and maybe we put that to aside a little bit because this is a world of contracts and legal agreements and banks and regulation, right? But I think there are some useful benefits, right? So you can really track and locate the collateral. It's really locked into custody. It makes tracking easier. We're talking real-time settlement outside of banking hours. So do you see some financial benefit of DLT? Before we jump into some of the solutions we're seeing out there, but do you see some potential financial returns or financial gains to that optimization piece through DLT?
Yeah, I mean, the institution that can solve the problem of, if you're a large bank, a global bank, you're going to have collateral obligations to counterparties, to CCPs. You have to hold high quality liquid assets if you issue covered bonds. You have a lot, you have repo desks, you have sec lending desks, and the list goes on and on. So across all of those different obligations that you have, how are each of your desks managing their inventory, and how are they efficiently moving that inventory from where it is to where it needs to be? And are you able to track that across all of those different sort of relationships and obligations that I spoke about? So the extent to which a DLT solution can say, we know with certainty, here's where the collateral is. We know how to pull it back, and we can pull it back quickly. We know how to substitute. We know how to run an optimization algorithm. The extent to which there's a solution that can do all of that, that's what the industry needs. They need a way to optimize across all of those obligations. And again, optimizing meaning, that they're using the best collateral for the particular situation that particular desk is in the context of the entire relationship that you as a bank have with all those different counterparties. So there's definitely a solution for that problem, and DLT might be one of the solutions in order to again, reduce those financial costs of the collateralization trend that we see.
Yeah, I think there's some definite examples of that, right, Stephen? So we've got, in terms of specific solutions, there's obviously more than just this list, but we have HQLAX, right? So they're working with the R3, the Corda blockchain, to tokenize collateral represented on a blockchain, create those efficiencies that you mentioned around collateral locking, tracking, and optimizing, right? So that's a good example of a firm that's targeting that use case. The others are, of course, we mentioned earlier, Cloud Margin, working with IVNO. Again, another example of tokenizing financial assets and representing them on a ledger. Again, we're not talking about the actual movement of the asset itself. It's really happening on that ledger, right? As opposed to crypto land, which we can get into in a moment. Obviously, there are other firms like Broadridge that are working with their partners, digital asset, to think about repo and collateral as well across the blockchain. But I think that the DLT is very exciting, and sometimes that we think about it as a solution in search of a problem. But I think what we've been clear on throughout this is that collateral does have some real problems, and there are definite tangible benefits that could be solved through DLT, which is kind of what's exciting to me to see, represented here, is the potential for meaningful benefits from that. Again, the industry needs to take some time to really measure those benefits, to participate in these partnerships and POCs. We're seeing a number of banks gravitate towards HQLAX for the moment. We've seen some recent press releases around that, but there are lots of other providers out there that can offer the tokenization benefit. But I think that perhaps to to finalize on here would be, what is it specific about collateral that's maybe harder for the DLT providers to sort of figure out, right? I mean, you can't just, say, oh, this is a great use case, I'm going to target it. Maybe are there some potential drawbacks or pitfalls or other things you want to point out just that makes these types of initiatives difficult or otherwise create some friction there, just to be fully balanced in our assessment?
I mean, I think you brought up some of them, like the idea, the regulatory environment. So the regulatory environment is a driver for change in the industry, but I'm talking more about how different banks view the regulatory environment that surrounds digital assets more broadly and what that means for the adoption. And again, in some ways, it might not necessarily be something specific to collateral and DLT that make it incompatible. It could very well be that there are other solutions that are not DLT that are more integrated already, or maybe a smaller step forward for the existing infrastructure. I mean, we did, as I say, we've spent with the industry, the collateral industry has spent 10, 12, 15 years building up these key pieces of infrastructure. And we no longer trade spreadsheets to do reconciliation. We no longer email PDFs of collateral calls. There are a lot of significant improvements that have been made, and there's a big infrastructure that's been built that a lot of the collateral practitioners utilize. And so maybe the competition to DLT is really, the incremental change to that existing infrastructure is less than trying to adopt a DLT solution. But that's why we want a competitive environment where we see multiple solutions using a diverse set of technologies in order to figure out what is actually best and what can help solve these problems.
Yeah, I think you hit on it well earlier. We talked about sort of the medium term and the long term, because clearly DLT has a role to play in this space over the long term. These markets are opaque, right? These are not transparent markets like equities or some markets like fixed income. Some certain fixed income markets are pretty opaque or pretty transparent as opposed to opaque. But at the same time, these things take time, right? People have to test and learn as they go. And you mentioned the specter of looming regulation. So clearly the presidential working group, the Treasury, the SEC, even the CFTC are taking a closer look at anything in crypto land, starting with security tokens, looking at digital asset securities, and clearly anything this significant to financial markets. The specter of Lehman is still out there in terms of collateral. Anything this significant is going to be looked at carefully by regulators, by banks, as they think about their own risk and risk appetite. So quite important to point that out, that yeah, there's more regulation clearly coming. So will that help or hinder? Perhaps a bit of both.
Right. Well, and then I think you're talking about the regulation on sort of more of the digital asset side, and think about the regulation more on the processing side. Again, this is where those industry solutions have really come in to help. And so whether you're talking about, how ISDA has standardized legal agreements, and so there's a lot more standardization of what that looks like, standardizing data models for exchanging information back and forth about various risks that you have. That standardization lends itself much more to various operational improvements. And so those are the pieces of infrastructure I think that are going to be so helpful to the industry and may even accelerate, some of the DLT work as well. But I think for right now, if you talk to a lot of practitioners, especially those that are in the derivatives, swaps, collateral management space, there is a deadline on September 1st of 2021 for UMR, and then September 1st of 2022 for UMR. And there is so much work that has to be done around legal negotiation, account opening, all of these other parts of the process. I do feel like there's so much focus on just let us get through these next couple of phases, which is why it is important that we start to think about the DLT, because we don't want to be so caught, looking at the weeds of account opening that we're not thinking about, well, what are our plans for 22 and 23 and 24 as we start to think about how to take the next step in improvements.
Well said. Yeah, there's definitely industry drivers that'll be moving things along, and we will be monitoring the application of DLT and other emerging technologies across the whole collateral life cycle, as you mentioned, across these various steps. we can't ignore just the simple efficiency gains that we mentioned earlier about just adopting software, SaaS and cloud native, and building those ecosystems and bringing partners together to solve industry problems, but certainly want to take a good look at DLT over the medium term to see what it can do in this space in and around collateral. And speaking of collateral, we should also mention that, crypto itself, right? So crypto itself could, in theory, although some of the banks have not really adopted this en masse at this point, could in theory view crypto itself. So let's just call it Bitcoin, right? That's the vast majority of the market cap, as a high quality collateral for a high quality asset for lending purposes. Clearly, there are some wealthy entrepreneurs, investors who have accumulated lots of Bitcoin. So what are banks going to think about that as collateral? Who's going to track and monitor that? Who's going to hold that in secure custody so banks can lend against that? That is another area that we'll be focusing on. And we have some current studies out and research out in order to extract that information on your behalf. And we'll be publishing an upcoming study on digital assets that will cover some of that. Clearly, when we talk about lending against these assets as collateral, there are other regulatory factors, there are capital requirements, there are all sorts of things. There's secure custody, things to think about. But clearly there are other high quality assets besides treasuries out there. Stephen, I don't know if you had any thoughts on that before we wrap up this update here.
I just think that's a really exciting topic. It's a little bit, off to the side of the core collateral management industry that I think most people think of when they think of lending and derivatives and clearing of futures and swaps and all that, but it is a fascinating part of the discussion, and I think it's one that's well worth watching.
Excellent. So we've given you a preview of coming attractions there, but we wanted to thank you, our audience, for attending this market structure update, and we look forward to talking to you again soon in the future. Thanks very much.
Thanks, everyone.